Well, welcome to the June 2025 Investment Strategy Brief. We're going to get into the idea that the markets, generally speaking, have been resilient, and that's amidst a variety of tensions happening. So we're going to get into that. And in fact, well, let's start it off with geopolitics. So basically, coincidentally in a way, over the last week, my team and I updated and republished what we call our geopolitical dashboard. So recall this frames up different kinds of risks that we see either happening or potentially happening around the world, really around international relations and how countries and regions get along or not. And of course, at the top of the list in a way is U.S.-China competition, which we're very focused on, as everyone is. But the whole idea is to sort of frame up other things that are happening or could happen and what the implications of those things are. Now, coincidentally, one of those risks is the idea of a Middle East war. And of course, we've had sort of an update to that situation. So I want to first get into a little bit the context of what's happening with the recent missile attack by Israel on Iran and the retaliation. But also, then we'll talk a little bit about market reaction and where we go from here. But to take a step back and look at sort of the longer timeline on Iran and the nuclear issues program, if you will, there, and the sort of global country interaction and sort of oversight of that. It goes back at least as long as 1968. When essentially Iran signed a deal, Nuclear Non-Proliferation Treaty, NPT, agreeing not to pursue nuclear weapons. Then we get to this century, 2002, and some sites were discovered that sparked some concern. In 2015, Iran and a number of countries signed what's the acronym JCPOA, basically limiting the nuclear program in exchange, in this case for Iran, of sanctions relief. In 2018, in his first administration, President Trump withdrew the U.S. from that agreement, and then that sort of, in some ways, triggered Iran starting to scale back on its compliance of that. So then here in 2025, we, kind of to jump forward, we saw the year begin with the U.S. and Iran beginning nuclear talks. And then in May, what's called the International Atomic Energy Agency, IAEA, that's the UN's nuclear watchdog, reports that Iran, in fact, has been enriching uranium is sort of more than expected, close to weapons grade. And in June, they sort of more formally declared Iran non-compliant for the first time in 20 years. So then with that action, Iran responds by launching a new enrichment site and installing advanced centrifuges, obviously with the idea of building a nuclear capability. Now, as it relates to the sort of this escalation and where we've come from in terms of this exchange between Israel and Iran, of course, the attacks in October of 2023 of Hamas to Israel was a notable sort of event, and that in a way was sort of a catalyst to sort of focus, especially Israel, on being less oriented towards a deterrent of action, military action, right? And ultimately, as we move forward into 2025, the idea was, and I think the Trump administration was very focused on trying to get Iran's attention to basically limit its nuclear program to avoid things. But ultimately, before additional talks, Israel strikes Iran and nuclear and military targets, takes out a lot of the military leadership. Iran has tried to respond because of the defenses in Israel. That's been somewhat limited. And the objectives have been stated to be to cripple their enrichment efforts, disrupt their leadership, and weaken their defenses. So there has been sort of missiles and drones launched by Iran, but again, the defense systems of Israel have kept the impact of that somewhat limited. And so all of this leading to still Trump suggesting, and I think the world now is suggesting that Iran more formally commit to backing off. But the bottom line is we're in sort of a narrow, at least, warlike situation, and anyway, the idea of a Middle East war, it seems to be coming to a fruition as it relates to our geopolitical risk dashboard. Now, as it relates to market reaction, we'll just mention a couple of things. The first is that the U.S. equity markets reacted somewhat negatively, but not overly so, at least so far. So markets were down, I kind of think, in the 1% to 2% range on Friday. And then notably, oil prices jumped, in round numbers, think both spot and futures, about 7%. So they went up with this anticipation, this worry about supply chain on oil. But again, that's after really this year, oil prices declining a good amount, really because of things like U.S. producing more and sort of non-OPEC supply being up, for example, maybe a little bit around a slowdown in the economy, but potentially. And so think of it as oil prices have gone down. They've come up a little bit, but they're actually not yet back even to the start of the year levels, right? So all this to say, it's early. We want to see whether things calm down. For us and firms in our industry, everybody's going to be focused over the coming weeks on how this goes along and whether we see resolution. Because, to the degree we don't, of course, we could see energy markets destabilize, and by extension, animal spirits and worries and a slowdown in the economy, whatever it might be, that could trigger negative volatility in the markets. So again, all in focus. Now, let's take a step back and see where things are when it comes to the kinds of policy changes that we've been anticipating in D.C. So we've talked a lot about tariffs and trade. We'll get into a little bit sort of some relief we're seeing there. We're talking a lot about fiscal and tax policy. There's a bill making its way through Congress to try to get passed. There was this idea of the Department of Government Efficiency and changes in health and human services, and of course a much more aggressive immigration and border policy block. And then the Department of Education changing quite a lot. One data point that I'll share is that the DOGE, Department of Government Efficiency savings, has been scaled back so far to about $180 billion, with a good amount of that coming from health and human services. And notably, Elon Musk basically has stepped away from his role at DOGE. And in doing so, a little bit of a feud is broken out between Musk and Trump, really around spending. So we're going to talk more about spending in a moment. But the punchline is that this one big, beautiful bill that's making its way through Congress is resulting still in a sizable deficit. And there's a lot of noise and news about things like the extensions of the tax cuts adding over the next 10 years, really in the scheme of things, a little bit to the deficit. But at the heart of it is the government spending too much. We're spending a lot more, about $2 trillion in round numbers, than we are taking in tax revenue, and that's adding to the debt, and that's an issue. So I think Elon Musk is very focused on that, as are others. And so there's a little bit of a tension between him and Trump, although it seems to have backed off just a little bit. Now, this idea of worries about change in policy, we've talked before about an erosion in animal spirits and that potentially unleashing some negative experiences in the markets. And of course, Liberation Day with tariffs did so. But what we've seen is almost the resilience of the U.S. and optimism leaking its way back in, and the market sort of recovering, and so that really relates to the potential for elements, at least, of our bull case scenario from our outlook unfolding. The idea that deregulation and lower taxes, maybe a bit more business activities around things like M&A, to the degree that plays in, that could sort of overdo and sort of outshine the worries about trade or tariffs or whatever, and ultimately see the economy and markets continue to chug along, right? And so no one knows really where things are going to land, but there's almost this tension or battle between the negative forces and the positive forces that are influencing both the markets day to day and volatility, but also sort of the direction of the market as we look forward. Now, same kind of thing with the economy, right? So we've seen the economy get back to trend. We've talked about that V-shaped recovery from the pandemic, closing and reopening. Notably, that first quarter print for 2025 is slightly negative, really due to tariffs and a huge jump in imports. that really had a negative drain. There's a lot of talk that that's going to be reversed in the second quarter. So there's a little bit of tariff-oriented short-term noise in the economic data in the first half of 2025. But when you look at these sort of the anchors to economic growth, and in particular the consumer, things seem to be in a pretty good spot. In fact, when we look at retail sales, while it bounces around, it's generally been positive. When we look at sentiment and confidence, there's been a little bit of a recovery from a negative sort of sentiment and feelings to something not quite as negative at least. We've talked about interest on debt going up and a reasonably balanced normalizing job force, labor force, where, again, employment's pretty good, and that makes the Fed feel confident about leaving things where they are. Anyway, on the sentiment side, business-related confidence had been higher into and through the election. It had fallen really around the tariff issue. It's now similarly starting to recover a little bit. So it's the kind of thing we keep an eye on when it comes to business activity. All to roll up to this idea, which we talked about last time, that the forecasts from around the industry are calling for continued economic growth, but a little bit more muted than what we've seen in the last couple of years. So the consensus number is 1.4%. That's sort of the average of all the different shops. And that consensus number was 2.1% as we started the year. So you can almost think of that as the delta of 0.7% being sort of a softening around some of the issues we're talking about, the uncertainty of policy and animal spirits softening a little bit. But notably, not a lot of folks calling for recession. So when we have an event like the Israel tax and the potential for a disruption in oil supply chains, that's the kind of thing that could weigh on the economy and getting business done. And so ultimately, that's the kind of thing that folks like us are going to be unpacking in the coming weeks to try to understand where we're headed. We're blessed, as I've said before, by Dr. Lindsay Piegza, our chief economist, who will dig into things like this. So we've seen some good work from her on the potential impact of tariffs. And I'm guessing she'll jump in and analyze a bit more oil and what's going on in the Middle East. But notably, when we focus, as we often do, on inflation, despite all the talk and worry about elevated or resurging inflation, when we look at the data, so the consumer price index, the producer price index, and the PCE, which is a favorite of the Fed, basically the prints are coming in very muted. So absent tariffs, I'd say people would start to talk about the possibility of us being back to the Fed's 2% target. And in fact, when we look at this happens to be rolling 3-month periods, but if we look at the rolling 4-month period, just as a slightly longer period, basically all the prints, PPI, CPI, core PPI, core CPI, which excludes food and energy, those core numbers do, or at least the 3 months ended, because PCE is going to take a little more time to get up the latest print. All of these numbers are basically on an annualized basis below the Fed's 2% target. You can see it visually here with the green line. And so, again, we'll see where it goes. People are worried about resurging inflation. We see that in the markets with break-even rates being a little bit above 2%. And, of course, survey data of the consumer, they're very worried about inflation, but notably that's very much related to which political party you're in, where Democrats are very spooked and Republicans generally feel like and expect inflation to cool. So again, a lot to focus on when it comes to inflation. Now we know, of course, that influences the Fed. So I mentioned a sort of a good labor market, and so there doesn't seem yet to be overly worries about a recession, for example, and an impact on the job market, and then the worry about this uncertainty around trade and tariffs leading to potentially more inflation. So the Fed's had a sort of a tight policy, meaning they have rates up high, and they're going to keep them there for a while. That's what they're saying, to make sure that inflation comes under control. This chart, which we show a lot, shows, gosh, if we go back to April, there was a little bit more optimism that the Fed was going to cut rates. These are Fed Fund futures that implied 4 cuts this year of a 1/4 point each, or 1% overall. That has been softened to 2 cuts and starting a little bit later in the year. And so that's the market interpreting everything that's going on. The worries about renewed and re-energized inflation, and the Fed's saying we're going to pause, we're going to wait until we see more evidence that inflation is under control, at least until the job market seems to be impacted with this tighter policy. So the Fed, needing to sort of continually focus on its dual mandate: jobs, maximize employment, by implication a strong economy, and yet stable prices. And so they go through day to day, month to month, focused on that. Now, on the Federal Reserve, another colleague we're blessed to work with is Brian Gardner. That's Stifel's chief Washington policy strategist. So he's talked a lot about sort of the Fed and the makeup of the Fed. There was, bubbling about the potential for Chair Jerome Powell being fired by Trump. That doesn't seem to be happening. But his term is up in the middle of next year, May of 2026, as chair of the Federal Reserve. So names are starting to emerge as potential replacements for him as chair. And two that are notable are Scott Bessent, current Treasury Secretary, and a former Fed governor, Kevin Warsh. And essentially, these are both important, in my view, considerations, because they're both number one, very experienced in the financial markets, each in their own way. And number two, they're both pretty nervous or cautious about the expanding U.S. debt. So almost think of it as, in the government, we need folks who are going to focus in on this deficit issue and the debt issue, which brings us to that idea of a fiscal trajectory and the need for a fiscal transition. We've talked about this month to month, but the debt remains high at approaching $37 trillion. The cost of our debt, with interest rates having risen, eat up a lot of our discretionary budget. It's money that we would otherwise be able to spend on a discretionary budget. And the forecasts from the Congressional Budget Office, for example, the CBO, are for that to continue because of that deficit, right? The deficit being, in round numbers, $2 trillion and growing a little bit. And so what we've seen, certainly from Bessent, certainly from a bunch of financial industry leaders, are calls essentially for greater discipline and sort of a plan to deal with this issue. And, again, I just would reiterate that this is particularly important because interest rates have come back up and the market is telling us that they will remain elevated, that there's not a lot of reason for things certainly to go back to the pandemic levels or even after the financial crisis, when there was this view that we needed low rates to kind of heal the environment. And so, the markets are projecting basically that interest rates will stay higher. We continue to believe that this is a problem that can be solved, but it requires leadership and ultimately a plan and action. So that is something that remains in keen focus for us. Now, turning to the markets, I mentioned interest rates being high, so they've been a little bit volatile with all this action on whether the Fed's going to cut or not. If, inflation number comes out and it's really good, meaning low, maybe rates pop down a little bit. Oh, then we have, unfortunately, an attack, and maybe that increases oil, maybe commodity prices a little bit, and so rates might pop up a little bit for that. So think of it as interest rate volatility, but against a level that's been pretty high. And as investors, we've seen clients re-engage with the bond market more actively and get money put to work in a diversified portfolio where the yields across the various categories, as we've discussed before, remain pretty attractive. And so that's something that we've kept a close eye on. Now, when it comes to the equity market, this chart that we've looked at, which has been dramatic through the year 2025, remember, this is the chart showing the first year of a presidential term. On average, the blue line shows that on average the market's positive. The orange line was Trump's first term. The gray line is this year. You can see the big drop with Liberation Day when tariffs were announced, and then sort of these moves related much to sort of a pause on those tariffs, deals being cut, and sort of a signal that many of the worries were a little bit overdone when it comes to trade and tariffs, and so the market's kind of come climbing back. But hey, as I mentioned, there's all kinds of things going on that could cause the market to be more volatile and to turn back down. So we'll keep a close eye on that. But I think as long-term investors, we remind ourselves that, hey, when we look at current levels, this level was a record at the beginning of December. And so at a time when people felt pretty good about their portfolios and returns and all that. So, we've seen some volatility, but things seem to be okay. On a valuation basis, that 10-year look at price earnings ratio, the market has recovered to a point of, once again, on a cap weighted basis, looking overvalued, think 17 to 18% when looking at price earnings ratio. But notably, when we look at it at individual stocks on an equal weighted basis, so essentially things are much more close to normally valued. And all that tells us is that if you're diversified and buying lots of different kinds of stocks in an equal weighted way, you likely will benefit in this type of environment. I mentioned the idea that the market's recovered. We're not quite back to the records before, right? But when you look at things like year-to-date numbers and numbers rolling over the last year, basically the market's performed well. And equity markets are holding up given everything that's going on. Now, a couple charts that I think looked at last time, but I just want to reiterate. The first is the idea of calendar years, where we can keep track of calendar year returns. This happens to be since the start of this century. And, round numbers, 2/3 or a little more of those bars are positive, right? So on average, you'd expect the equity market more often than not to be positive. But in every single year, you have a period of a drawdown, a peak to trough return. And you can see that for 2025, for example, that number was 19% when we had that Liberation Day move. And that's a big number. You're 1% from a bear market by formal definition. And so people were looking at that and saying, oh my goodness, we're never going to recover. But holy cow, really since the beginning of the year, the market's gotten back to a point of being positive on a year-to-date basis. And so right now, if we were to close the year out, 2025 would count in that bucket of positive returns. Now, it's just coming on mid-year, so we have over 6 months to go, and we'll have to kind of see how things unfold. But it just reminds us that despite that during the year volatility, it's important as a long-term equity investor to stay the course. This next chart, which again we've looked at before, it happens to show the 15% or more negative moves, I think since the late 1920s. And then for the next 12 months, how the market recovers, and then the number of months it takes to get back to the full recovery, where you can see a lot of times that happens very, very quickly. So it's so common for a client to feel nervous and want to jump out of the market, and then ultimately they'll have a hard time getting back in. And so, of course, for long-term investors, we guide folks to stay fully invested and think about things like diversification and just making sure, things like rebalancing between stocks and bonds, all that's kind of important. So to close out, as we often do, looking forward, we are dealing with a lot of nerve-wracking topics. And yet I would reinforce the idea of thinking long-term. I would invite folks to look at our long-term investment themes. It is an anchor to the way we think about investing. It's everything from AI to how we secure resources, think oil these days, how demographics are shifting, how consumption is shifting, how despite how nerve-wracking it is, the competition between the US and China is actually productive in the sense that we work harder to get better. So those long-term themes are always present, and we invite people to check it out. And you can do that again on StifelInsights.com, a website just for you. Holds this video, a podcast that goes with it, the slide deck that goes with it, and a bunch of other content. So, hey, listen, really appreciate you taking the time to watch the June investment strategy brief. Thanks so much, and we'll see you in July. Thank you.